Ghana is moving to reset the rules of its gold mining sector, scrapping long term stability agreements and sharply increasing royalties as gold prices hit record highs. Now, the reforms mark a shift in policy direction. The government wants to capture more value from mining while still keeping the sector attractive to investors. So, what is changing? Now, the heart of the reforms is the end of stability and development agreements, contracts that allowed mining companies to lock in taxes and royalties for up to 15 years. Under the new approach, one, expired agreements will not be renewed. Two, existing ones will be phased out by 2027. And three, development agreements will be abolished entirely. A draft bill expected in Parliament proposes a new royalty regime starting at 9% and rising to 12% when gold prices exceed $4,500 per ounce, roughly double current rates. Now, the reforms also introduce tougher local content rules, requiring mining firms to source more inputs locally and support Ghanaian businesses. But why is Ghana doing this now? Gold prices are hovering around $4,590 per ounce, giving mining companies strong margins. Authorities say the current framework leaves Ghana with too small a share of the upside, even though the country bears the environmental and social costs of mining. The Minerals Commission argues that stability and development agreements initially meant to attract investment have increasingly been misused, with some firms expanding abroad while neglecting basic obligations at home, including payments to district assemblies. So, who will be affected by these new rules? Major producers, including Newmont, AngloGold Ashanti, and Goldfields, operate under stability agreements. Newmont's agreement, which expired in December 2025, will not be renewed, while similar deals held by AngloGold Ashanti and Goldfields will expire by 2027. So, will this not put investors off? Well, government says no. They argue multinational miners already operate under stricter fiscal regimes elsewhere and remain profitable. Mining, they say, ultimately comes down to the numbers. So authorities say they are engaging smaller operators and new projects to ensure the new royalty structure does not undermine investment, especially in marginal mines. But why does this matter for Ghana? Now, if this rule is implemented, the reforms could one, boost government revenue, two, deepen local participation in the mining value chain, and three, improve accountability and compliance in the sector. But success will depend on clear legislation, consistent enforcement, and sustained dialogue with investors. Now, as Parliament prepares to debate the proposed law, Ghana faces a similar challenge: how to maximize returns from its natural resources without undermining investor confidence at a time when gold remains one of the country's most valuable assets. Now, follow Business Outlook with Vivian Kailoko for more.